Welcome back to the show, everyone. This week we are talking about the topics in the lending world, and I am fortunate to not be an expert in this world, but have an expert that I can rely upon. And so I am bringing you my personal expert in the mortgage lending space. This is Dakota Baisa. Dakota is a mortgage broker, and welcome to the show first and foremost.
Thanks so much, Anthony. Love watching your show. I'm excited to be here. Thanks so much for having me.
Appreciate that. Thank you very much. And I want to spend some time delineating exactly who you are and what you do. You are a mortgage broker. And so can you explain what that means versus, somebody just going to any bank down the street and talking to their mortgage department? What's the secret sauce here?
Yeah, I mean, basically at the end of the day, it's access to products and multiple products, a lot more products that you're going to find with, your typical, retail bank or retail lender. They've got one product typically for conventional FHA, VA, USDA. It's very basic. They don't specialize in mortgages, right? We do. So we've got access to 50 different wholesale lenders. And we've got multiple different products. Someone who wouldn't typically qualify under traditional means, we've got products for them. We've got products for just about anyone who wants to buy a home. So that's basically the big part of it. The other part of it is we have access to 50 different lenders, which means the best interest rate on the market, right? So, you've got banks that they're going to give you a decent rate, but, on average, typically a broker is somewhere, at least our shop, a quarter to a 0.5% better on average. So, there's big savings there, especially being in the rate environment that we are right now. That's pretty important. That's pretty hefty. So yeah, that's the biggest sell right there, is just access to a lot more products, a lot more, better pricing options. And so, yeah, that's the biggest push.
All right, so 2 minutes in, folks, packed full of actionable data already. Get yourself in touch with a Dakota. If not in Dakota's market, get in touch with Dakota. We'll show you all about how to do that. If you're going to the grocery store and you're price comparing two different types of sugar, you should probably be comparing your mortgages as well. And so that's what I want to talk about. That's what I want to talk about today. And not that long ago, Dakota had a seminar with her broker partners, folks like me. And she talked about different scenarios where, above and beyond shopping 50 different lenders to help you get the most attractive pricing, there's some other strategies that can be involved in this. And if you're anywhere from a first-time home buyer to, maybe you're looking to move up in house, whatever stage of life you're in, you can benefit from this. And so it's content that I would love to have Dakota take the lead on jumping in, because these are your slides, Dakota. And so I'm going to let you run with this. What's the secret sauce on this piece?
Yeah, so my biggest part, the reason why I wanted to share this with you all when I did was, we've got a lot of folks who go out there and, house has been sitting for a couple weeks, and hey, I want to knock $5,000-$10,000 off of that list price that they've got. And there's nothing wrong with doing that. You'll save a little bit on your monthly payment, but a lot of first-time home buyers especially, but no one's really immune to it. Everyone wants to save money, right? So there are strategic ways, if a home's been sitting a little bit longer and you're looking for a price reduction, the purpose of this slide was to say, like, you're asking for $10,000 off the list price, why don't you consider putting that, towards the interest rate, either directly or indirectly via a 2-1 buy down, a 1-0 buy down, some sort of buy down that temporarily brings that interest rate down, for a year, 2 years, 3 years, depending on which one you go with. And hopefully kind of eases us into, that, fingers crossed, year from now when interest rates finally drop, right? So that's basically the gist of this. So in this example, we used a $350,000 home, which is a good priced home here in, central Indiana. We're using, insured conventional financing, and these folks are putting 5% down, and they have a 740 credit score. So their interest rate at par is about 7.5%. This was a couple weeks ago, so this is a little bit, what is that, 3-4 weeks ago? So interest rates are a little bit lower than that actually right now. Climbed a little bit today, but we're not getting into it. But so we're looking at a 7.5% interest rate. So, let's say, this $350,000 home, here's the monthly payment. It's $2,826. That's inclusive of, taxes, insurance, the whole nine. So in the first example, it's a $350,000 list price, $10,000 price reduction. Your monthly payment, like I said, you're going to save money. You save about $68 a month and $816 a year. That's great. No one's going to turn their nose up at that. But if you look into, let's call it, a direct interest rate buy down. So you just move yourself down that rate sheet and see what you can get for $10,000. That's our second example. So $350,000, all of it applied, or that entire $10,000 in seller concessions applied to the interest rate. That's going to buy you down. I think in this example, it was 6.625% or something like that. Anyway, so your monthly payment, inclusive of taxes, insurance, the whole nine, about $26.31. That's $195 a month saving versus $68 a month just taking it off of the list price. So already a big win right there, just buying the interest rate down directly. What I prefer and what I like to see a lot of folks doing right now is either a 2-1 or a 1-0 buy down, because the expectation is that rates aren't going to stay up here forever, right? So that $10,000 directly applied towards your interest rate, it's good. It's going to save you money, right? It's going to save you $195 a month. But, if interest rates come down even 1% a year from now, the likelihood is you're going to refinance, right? So you're going to save that anyway. So, let's apply that towards, a 2-1 or a 1-0 buy down, even a 1-1. So in this third example, $350,000 purchase price, $10,000 in concessions applied to a 2-1 buy down. The first year, your monthly payment for that first 12 months is only going to be $23.89. And the second year, it's going to be $26.03. And by the third year and beyond, it'll be back at that normal, what it would have been in the beginning at $28.26. Again, with the expectation being in 3 years, we're going to see lower interest rates than 7.5%. So over the course of 2 years, you're saving $7,900. That's quite significant.
Yeah, and this is exactly why I wanted to have you on the show, to talk about different strategies like this. I know in my personal experience, people really get hung up on that purchase price. And in each one of these scenarios, we're basically putting the same $10,000 to work. Dunder Mifflin represent. I love the coffee mug. That's totally worth getting sidetracked. Anyway, we're talking about pushing paper here. That's what this is all about.
Yeah.
In each one of these scenarios, we've got $10,000 that we're putting to work, and you can just see here that putting it to work in different ways can net different results for you based on what you're interested in. And so this is going to look different for you in your situation. So again, I'm not looking to solve every single person's problems in a 10-minute video here. Someone is going to need to walk you through this, and Dakota's that type of person.
Yeah, I love working through, different scenarios like this. And, further, what I didn't hit on was, this, if you're at getting $10,000 in seller concessions, you're applying $7,900 of it roughly to, your interest rate buy down. You get the benefit of the lower interest rate, but there's still about $2,100 left over there that'll go to offset your closing costs and prepaid. So it makes it really affordable to buy a home. So anyway, no, I love talking through these kind of scenarios, any kind of creative financing. Love that. Yeah, I work really closely with a lot of my clients to make sure that we're getting the scenario that fits their family's, needs and their future wants and goals. So.
Absolutely. And so want to talk about one more slide that you put together, and this gets even more creative. This goes into multifamily housing, which is near and dear to my heart. I've been a multifamily junkie for a number of years now in both a personal and a professional world. And so walk me through what exactly we're doing here. So rather than me buying a single family house, I'm buying an apartment community?
More or less, we can, so residential lending, we can go up to 4 units. So
there it is.
I mean, it is really cool. And I mean, imagine if, this had been around when you and I first started buying homes, right? Like, this is such a good way of creating future wealth, especially for, our generation and, Gen Z, where we really have to have the side hustle. Buying a home, you have to have, a lot of folks need that additional income, roommates or multifamily housing is a great solve for that. So, yeah, I thought this was a really important topic to hit on because it's still, a lot of realtors, surprisingly, in the last few months didn't realize that this was a rule. Now you can buy up to 4 units as a primary residence with only 5% down, whereas it used to be, minimum 15% down for a duplex, you know what I mean, and 20-25%, you know, for anything greater than that, which is, you know, it's just a huge win on behalf of Fannie Mae to make housing more affordable for folks who can get their foot in you know, multifamily housing. So yes, it does have to be primary residence. Obviously, you're going to be renting out these additional units, but you can also use that income to help qualify for the loan as well. So, you know, when you order your appraisal, you get a rent schedule with it, and whatever those rents come back at for each unit, you get to use about 75% of that to help offset your debt to income ratio. So not only are you building wealth by having, you know, tenants and, you know, your home's appreciating year after year, you actually get to use that to help qualify as well. So it's just a huge win. It's a huge win, especially for younger generations, you know, and getting your foot in the door. Because before, you know, you could go FHA for a multifamily, just 3.5%, but finding homes that, you know, qualified for FHA financing, multifamily homes that qualified for FHA financing was the struggle, and also getting sellers to accept it. But so this is a huge win. Insured conventional financing, 5% down, you know, house hacking at its finest.
This is house hacking. This is an entire generation of folks growing up on bigger pockets, on different side hustles, all of the above, making their dreams come true. And I sit here on the development side of this, and I'm going to harp on my soapbox for a little bit.
Yeah.
If you are watching this video and you are somehow connected to a city councilman, a town councilman, a plan commission member, you need to be advocating for more of this housing typology in your communities, because this is called the missing middle. This is something that typically does not exist in suburbia whatsoever, because there's no place for it in the zoning maps. It needs to be there. It serves a purpose, and it can help affordability in your area. So
yeah, I mean, I think that's going to be something that, you know, especially as, you know, home ownership gets, you know, further and further, I should say, you know, for lack of, you know, at the risk of saying something, you know, too dramatic, it's getting tough, you know what I mean?
Yeah.
So, you know, something like this is really going to help. It really could help a lot of folks, you know what I mean? Like I said, afford a home ownership, but also, you know, reasonable housing costs for a lot of other folks as well. You know what I mean?
Yeah, I completely
aren't in a position to buy yet and have to keep renting.
I completely agree, and it's a great step into the market. And so we got one more slide here where we want to talk about how can people get in touch with you, Dakota?
Yeah, I mean, I'm kind of one of those. I'm your typical millennial, right? My phone's always on me, so most of my clients have access to me via text. You can call anytime. You know, I'm right there on in the middle. That's my cell phone number. I pass it out. You know, you can catch me at the office sometimes, but if you want quick, immediate response, you know, call or text me. Emails also come through my phone, so pretty readily available there.
Absolutely, and I'll link to this stuff in the show notes as well. And so I wanted to bring Dakota to my audience, and anybody out there, you guys watching, she's a rock star. You're in good hands there, and if you're looking to transact real estate in the Indianapolis market, this is a team you can count on here. So we're having some fun here. This will be a video that lives in infamy for the deals that we do together in the future. And Dakota, I appreciate you joining me on the show this week.
Heck yeah, always a pleasure to get a chance to talk to you, Anthony. I appreciate it. Hopefully I was a little helpful here.
This is perfect. You were definitely helpful.
Awesome. Well, thank you so much. I appreciate it.
You betcha.